Nowadays, growth stocks and growth ETFs are all the rage. These are the ones making people very rich seemingly overnight. These stocks each grew insane, growing between 400 to 1,000% over just the past year. Carvana grew 883% in just 1 year, which means that if you had put $10,000 in 365 days ago, your $10,000 would now be worth $88,300. Who wouldn't want that? But then this growth stock promised huge returns in the EV charging market and actually went down 84% in 1 year. So $10,000 invested in that would leave you with only $1,600 today. You're all very smart, so I don't need to remind you that picking stocks is incredibly tough. And most people fail, so the smartest investors are stacking the deck in their favor by not investing in individual stocks, but instead investing in a group of growth stocks altogether. If you invest in a group of 100 growth stocks, there's bound to be a couple diamonds in there. So even if a couple mess up, the rest should help pull you up. When you invest in a growth ETF, that's exactly what you're doing. I'm gonna highlight 12 of the best growth ETFs on the planet very quickly, and then I'm gonna pick my #1 growth ETF. If I could only have one growth ETF for the rest of my life, this is going to be the one. My name is Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. Right now, the biggest hype is surrounding AI, so let me start with my favorite AI ETFs first. By investing in an AI ETF, investors can mitigate individual company risks while still capitalizing on the overall growth potential of ongoing AI development. Honestly, there's a couple of pretty solid ones, and I narrowed it down to my two favorite. Now, specifically in these specialized sector type ETFs, you are going to find a higher expense ratio, something like 0.6 all the way up to 1%. The two ETFs that outshine from the rest are the Global X Artificial Intelligence and Technology ETF AIQ, and then the Global X Robotics and Artificial Intelligence ETF BOTZ or BOTZ. Trillions of dollars worth of microchips will be up for replacement within data centers in the next few years to accommodate the rapid adoption of generative AI, and these ETFs hold a lot of microchip and AI companies. AIQ tracks the INDXX Artificial Intelligence and Big Data Index, which seeks to invest in companies that potentially stand to benefit from the further development and utilization of artificial intelligence technology. The expense is 0.68%, like I said earlier, which is kind of expensive. It has 84 total holdings. The current price of AIQ is $32.74, and year to date, it's up a nice 7.5%. AIQ's inception date was 2018, so only 6 years ago, but since that time, it's appreciated at an average rate of a little over 15% per year, which is nice. Unsurprisingly, the top holding in AIQ is currently Nvidia. However, the ETF also holds other AI players like Meta and Amazon. AIQ offers a broad and comprehensive exposure to the entire AI value chain, with exposure that ends up looking quite like the NASDAQ 100 index, but it's more tilted towards technology and mid-cap growth. Now, BOTZ or BOTZ is the other ETF here, and it provides investors with a more hardware and application-focused spin on AI investing, as opposed to AIQ's more software-heavy focus. BOTZ is the robotics and AI ETF, and it's one that tracks companies with adoption and utilization of robotics and AI, including those involved with industrial robotics and automation, non-industrial robots, and autonomous vehicles. The expense ratio is just like AIQ at 0.68%. There is only 43 total holdings in this ETF. The current price is $30.30, and year to date it's up almost 9.5% already here at the end of April. BOTZ has been around since 2016 and has an average rate of return of a little over 11%, but this should increase with the increase of robotics slated to happen by 2032. The top holdings in this fund are Nvidia, ABB, Intuitive Surgical Inc., and Dynatrace. Next on this list has to be semiconductor specific. The semiconductor market is projected to grow from $573 billion in 2022 to $1.3 trillion per year in 2029. Those last two did hold a fair amount of microchip style companies, but these ones are 100% microchip semiconductors. The first one is SMH, which is the VanEck Semiconductor ETF, and it's the most famous in this sector by far, but not necessarily the best in my opinion. SMH tracks the MVIS US listed Semiconductor 25 index, which is intended to track the overall performance of companies involved in semiconductor production and equipment. The expense ratio is 0.35%. Its current price is $217.72. Year to date, it's up 24.53% in just the past 4 months. The 10-year return is just insane, growing at an average of over 27% per year. 27% for just 1 year is nuts, but to have that on average for 10 years consistently, wow. The top holdings are NVIDIA, Taiwan Semiconductor, Broadcom, Texas Instruments, Qualcomm, Micron, and Advanced Micro Devices. The other one I'd like you to consider is actually better in my opinion, and more so because it has about half the expense of SMH while having a return that's almost exactly similar. SOXQ is the Invesco PHLX Semiconductor ETF. And it's based on that semiconductor sector index, which is designed to measure the performance of the 30 largest US listed securities of companies engaged in the semiconductor business. Remember that SMH had an expense of 0.35%, but SOXQ only has an expense of 0.19%, which is about half as expensive to own. The current price is $37.40. And year to date, it's up almost 18% this year in 2024. The 10-year return is 25.71%. The top holdings are very similar to SMH with holdings of NVIDIA, Broadcom, Advanced Micro Devices, Micron, and Taiwan Semiconductor. It's going to be hard to beat either one of those with average 10-year appreciation of over 25% per year. All right, let's go on the opposite side of the spectrum now, and instead of going at highly specified and special sectors, we're gonna go more into the broad growth ETF style. If you've watched this channel for any period of time, you know that I like this style of ETF more so for that broad coverage, which gives you a lot more safety and mitigates risk for all investors. But the issue here is that the return is definitely a bit lower than some of those specialty sectors. In this category, my 3 favorites are QQQM, VUG, and SCHG. There are a bunch more that are very much like this, but those 3 are my favorites. Most of you have probably heard of Invesco's QQQ, but I like QQQM better because it's almost literally the same thing, identical in almost every way, but it has an expense that's actually 25% cheaper than QQQ. QQQM is the Invesco NASDAQ 100 ETF, which includes securities of 100 of the largest domestic and international non-financial companies listed on NASDAQ. It has 103 total holdings, and the current price right now is $177.99 with a year-to-date return this year of 7.5%. The inception date for this fund is only 2020, but it's tracking the exact same index as its big brother, QQQ, and that's been around since 1999, so almost 30 years. So the 10-year return for that has been an average of 18.6% per year. The top holdings are Microsoft, Apple, NVIDIA, Amazon, Google, and even Costco. Side note, a lot of these funds in this video, and when you look up growth funds in general, are going to have a lot of the same top 10 companies. So you're going to want to do a little bit more research and research the next couple companies and even see all the different types of companies that they have so you can see how different funds differ from each other. The next broad growth ETF that I really like is called VUG. And this one is the Vanguard Growth ETF, which tracks the CRSP US Large Cap Growth Index. Vanguard funds are known for their low fees, and this one is no different at only 0.04%. It has 199 total holdings. The current price is $335.83, and year to date, it's up almost 10% this year on fire. The 10-year return is solid as well, over 15%. The top holdings is, like I said before, all these companies will look similar, but the top 10 include Microsoft, Apple, NVIDIA, and then also Google, Eli Lilly, Tesla, and Visa. Now, the last broad growth ETF that I absolutely love is actually the one that's up the most this year to date. SCHG is the Schwab US Large Cap Growth ETF, and it tracks the Dow Jones US Large Cap Growth Total Stock Market Index. It has an expense ratio just like Vanguard's at 0.04%. It has 250 total holdings. The inception date was 2009, so it's had a lot of historical data. The current price is $90.75. The year-to-date return, like I said, it's up the most so far in 2024 at over 11% this year. The 10-year return is also very nice at almost 16% per year on average. And the top holdings of this one, just like the two before it, the holdings are similar at Microsoft, Apple, Nvidia, and then also some Meta and Google. These next two are broad, just like the ones before, but with a little twist. These stick to companies that are only in the S&P 500, which I think is pretty cool. It's basically the S&P 500, but only the heavy hitters that are growth companies that are absolutely crushing it. VOOG is the Vanguard S&P 500 Growth ETF. The expense ratio is 0.1%, which is a little bit higher than normal, but when you start to get more specialized ETFs, this can usually happen. This fund invests in stocks in the S&P 500 Growth Index composed of the growth companies within the S&P 500. The total holdings in this ETF is 228. The current price is $298.50. The year to date is actually beating all those last three this year in 2024 at almost 12% gain so far. The 10-year return is solid at 14.5% per year on average. No surprise here for the top companies, as we see Microsoft, Apple, Nvidia, Amazon, and Meta rounding out the top 5. So like I was saying before, if you're looking at comparing ETF and you're looking at these ETFs that are all large cap weighted, they're all going to pretty much have the top 10 same, or at least top 20 same companies, because the top 10 companies that we have in the United States aren't changing. It's based off of how big they are, and that's how much weight you're going to see within the funds. And that's why it's important for you to make sure and check what types of companies and which actual companies are in the fund and have been selected for the fund, and not just looking at only numbers or metrics like growth or appreciation. And the other ETF within this category is very similar, but a lot of you like SPY over VOO when you're investing in the S&P 500. So this one is called SPY-G. And this is the Spider Portfolio S&P 500 Growth ETF. Like I said before, this one's very similar, but actually better in my opinion than that last one that I just talked about. I actually like VOO better than SPY because it has a lower expense ratio, but this one, SPY-G, compared to VOO-G, has a lower expense and it's a cheaper share price. The expense ratio of SPY-G is 0.04%, where VOO-G was 0.1%. The current price is $71.77, where VOO-G was almost $300 for one share. The year-to-date return here is over 12%, so that's better too. The 10-year return for SPY-G is almost 14.5%, which is the same as VOO-G, and the top holdings are almost identical, with Microsoft, Apple, Nvidia, Amazon, and Google in the top 5. Both of these options are valid, and I like them a lot. The last category of ETF that I'm going to include in this video is purely technology only. All the companies have to do with only the technology sector. Now these ones are not as crazy specialized as the first two categories that I started this video with, but definitely not broad like the last two categories. XLK is the Technology Select Sector Spider Fund, and it seeks to provide an effective representation of the technology sector of the S&P 500 index. It has an expense ratio of 0.09%. It has 65 total companies within the fund. The current price is a little over $200 per share. Year to date, it's a bit over 7%, and the 10-year return is nuts at over 20% on average per year. The top holdings are Microsoft and Apple, but then also Salesforce, Cisco, Accenture, and Oracle in the top 10. The next one is a favorite by many, and this is VGT. BGT is the Vanguard Information Technology ETF, and it just invests in companies with information technology, which is the hottest by far these days. The expense ratio is 0.1%. The total holdings is 313, which is actually a lot for a technology fund, so this brings risk down a bit for investors, which I like to see. The current price is $506.53, and year to date, it's up about 7.5%. The 10-year return is very similar to XLK as well, at over 20% per year on average. The top holdings, and no surprise since they're almost identical everywhere else: Microsoft, Apple, Nvidia, but then I do like to see Adobe in there, as I think Adobe is doing big things in the near future. This last technology one here, and then I'm going to tell you which one I think is the best. FTEC is the Fidelity MSCI Information Tech ETF, and it has an expense of 0.08%. It does invest in semiconductor companies and also software and technology hardware with companies like Microsoft, Apple, Nvidia, and then Adobe and Cisco in the top 10 as well. The current price for this one is $150.19, and year to date, it's up 7.44%. The 10-year return is beautiful and over 20%, just like the other two. These last three are almost identical, so if you pick one of them, you'll be okay, but definitely don't pick a couple of them because then it's just redundant at that point. Honestly, right now in 2024, it's super tough to just pick one of these because all of these have been on fire. If though I were to pick one and I could only have one forever, I would want to be smart and not only capture the one with the most upside, but also be cognizant of the one that has the least amount of downside. If you only invest in one sector, because it's super hot right now, if 3 or 4 years down the road that sector just dies out, your portfolio is going to be real sad. The smartest way for an investor to invest, especially if they can only invest in one ETF, would be to make sure and keep that thing as broad as possible, so that if any one sector were to drop, the other sectors within the ETF will help bring you up and you'll keep very, very safe. So my choice would be definitely from that broad group, which was either QQQM, VUG, or SCHG. I firmly believe that each one of these is a home run, and if you were to pick any one of them, it would be amazing, but my personal favorite is QQQM. The good news is that you don't have to pick just one growth ETF. But to keep your portfolio as simple as possible, I do recommend keeping it to a total of 3 to 5 ETFs. You can learn more about why in this video, where I go over a solid portfolio and how you can build one out perfectly for you and your risk tolerance, or you could learn about exactly how I invest in my simple 3-fund portfolio. This also goes over the exact allocation that I would suggest based off of your age, and goes over the exact percentages that I think is most optimal for you and your investing.